Good day, traders. This is the Daily Market Update live from the Tradelo trading floor. It's Thursday, the 6th of June. Some highlights from today's show. The US recession probability increases to 50%. The ECB is poised for a hawkish cut, and BTC is in play. Let's kick off and talk a little bit about some of the key overnight news, starting with Bank of Japan Governor Ueda. He has told us that the BOJ should reduce its huge bond purchases as it begins the process of moving or exiting monetary stimulus. Ultimately, what this does mean, however, is he keeps alive very much the possibility that next week the BOJ could begin the process of tapering its huge bond purchase program. Now, what that means, obviously, going into that meeting, is that there will be some long yen into that meeting, and they will be, taking the bet that the BOJ is going to take that next hawkish step. So, by and large, the pricing will be for a little bit of a hawkish tweak from the BOJ next week. What that means is if they don't deliver it, we are likely to see, again, further pressure on the yen as a result of the BOJ simply talking a big but not actually delivering. Let's turn our attention then to the United States. A key report out of Reuters looking at what economists expect from the Fed this year in terms of rate cuts. And what the report does is it tells us that most economists, 74 of 116, so roughly 2/3 of economists, expect the first cut to only come in September, and most economists only think that the Fed will cut twice this year. And what that means ultimately, if only 75% of economists think that the rate cut comes in September, means that the opportunity scope is for an earlier than expected cut. Now, sure, economic data has been very mixed from the United States, but what this report is telling us is that no one expects a rate cut to come before the summer. And moreover, we're only going to get one rate cut as we move into the US election in November. Now, again, like I said, data's been very, very sticky, and no doubt we're going to hear a lot about this as we move into that Fed meeting next week. But by and large, what I want you to take from this is that the consensus expectation is that no one thinks the current economic data is justifying any rate cuts coming anytime soon before the summer. Now, let's go and take a look at some of the key data we received yesterday, turning our attention to the JOLTS data. Very, very important. The odds of a recession are rising, and we can see that it's confirmed by what we have seen from US 10-year yields over the last 5 sessions. They have risen in terms of price, and yield has dropped 30 basis points as a result. Now, that's a very, very significant move. We saw something similar to this in October 2023. And if we cast our minds back to that point, at that same point, we saw a significant weakening in the economic data in the US. In other words, the market thought in October last year that a recession was incoming. That is also why we had a significant rate cut cycle priced by the markets. It was 6 to 7 rate cuts as we moved into the start of this year. Sure, economic data rebounded and it was a false front. So what I want you to pay attention to is that we saw that pricing in October, and we are seeing that same pricing coming into the market now. What that means ultimately is that the market's not going to suddenly stop pricing in a recession if the data keeps coming in weak. And that's what we've seen. We look at the last 4 or 5 weeks of data. We had a downgrade to Q1 economic data GDP. We had a very weak jobs print back in May from the non-farm payrolls. Consumer staple stocks, they've all been reporting very weak guidance, telling us that consumers who typically buy staple goods, they are pulling back. Manufacturing PMI has slumped. And just yesterday, and this is the key takeaway, this is the chart I want you to take a look at. On Tuesday this week, we had the JOLTS reported. And what I want you to pay attention to as you look at this chart is it's not necessarily what the absolute number is. Sure, there are still 8 million job openings. That's not the key takeaway from it. What the key takeaway is that over the last 3 months, the cumulative loss of job openings has been 750,000 jobs. Okay, now, yes, that on its own doesn't mean a great deal, but if we compare that to the entire 2023, what we see is that very much there was very little job losses over the entire 2023. Okay, yes, we in Q1 of 2023 we saw, roughly speaking, sort of a 1 million job losses. Then we gained back around 750,000 jobs. Then we lost 300,000 job openings. The reality there is that when we compare what's happened in just the last 3 months to what happened over the entire 2023, we see the rate of change has dramatically shifted. In other words, we are seeing firms say, we are no longer willing to have those job openings because we are now finally starting to see tight monetary policy filter into the economy. Okay, don't forget, the Fed was still hiking interest rates in July last year. We know monetary policy has got a significant lag. That lag now seems to finally be hitting consumers. Consumers finally seem to have run out of, excess savings, which is why we are seeing consumer staple companies telling us the guidance is weak, telling us consumers have pulled back. If we remember the sequencing of how this works, the consumer pulls back, then companies ultimately recognize the slowdown, they then stop hiring, and the cycle then ultimately fulfills itself. We see unemployment rise, and as a result, we enter a recession. Okay, jolts sent a significant signaling to the market, and that's why the bond market is responding. It is saying that not only do we have a repeat of October 2023, but perhaps this rate of change is signaling something far more significant. Now, one final note when it comes to eco data. Don't forget that the data we receive is lagging in essence. Okay, the jolts that we got back on Wednesday is not telling us about where we currently are. It's telling us ultimately where we've been over the last 4 weeks. So the economy is a lot weaker than what that data presents ultimately. So pay very, very close attention. We have, of course, got initial jobless today. Another key data point. It's very much forward looking. We get it every single week. Watch out for that big jump in sort of, claims. Keep a very, very close eye on that. And then also tomorrow is the highlight of the week. It's non-farm payrolls. Like I said, we had a very weak non-farms print last month. It was 175 odd thousand jobs, a lot lower than expected. Unemployment unexpectedly ticked up to 3.9%. If that unemployment ticks up to 4%, if that non-farms comes out weak again, bond traders are not going to hang around. They are not going to wait for any more confirmation. They are simply just going to push the odds of a recession a lot higher. Pay very close attention to that non-farm payrolls tomorrow. It's going to set the tone for the next couple of months. Now, let's then also go and take a look at the ECB. They are up in just a couple of hours, and it's very much telegraphed. They are going to cut today. Moreover, what they're likely to do next is also very well telegraphed. It's going to be a hawkish cut. What do you mean by hawkish cut? Well, they tell us we cut by 25 basis. We move the deposit rate from 4% down to 3.75%. However, what comes next is we remain firmly data dependent. What comes next is we are not going to commit to any kind of path of rate cuts. And that's what you're going to hear from the ECB today. It's a non-committal on when that next rate cut comes. Now, right now, the market thinks it's very much September and then again in December. So 3 cuts, that's by and large the consensus. And very much Lagarde is going to push as much as she can to tell us that. She's going to say, look, we cut today. The data's sticky. Wage data is obviously ticking up unexpectedly, as well as we are seeing some rebound in growth in Europe. And she's going to reinforce that. She's going to tell us the job's not done on inflation. They cannot be expected to cut rates at every other meeting. They will be meeting by meeting and data dependent. And so the rate cut cycle ultimately will follow the path based on the data. She will be non-committal. And that's why it's a hawkish cut. Now, what that means ultimately from an opportunity scope is that sure, you may get a little offer in the euro on the announcement of a rate cut, but that should very much be faded. And when she comes out with that hawkish tone, when she tells us that we're not committing to any further cuts at this point, you should see that euro not just take back that initial sell-off, but also rally perhaps to the high of the day. So that's the play of the day. It's very much just fade an ECB down move in the euro, so long as we do get that hawkish cut. Now, finally, Bitcoin is in play. Yes, we spoke yesterday in the Tradelo community about the importance of yesterday's move because we've now broken above that 71,500. Now, that in its own doesn't tell us we want to be buyers, but it tells us that it's now or never for Bitcoin. Okay, we've broken above that sort of key trend line, that key sort of downward slope of resistance that we've had pretty much for the entire year. Okay, Bitcoin has really been in this sort of flag formation for the entire year. Now, why it's now or never is because there is some short-term positioning looking for this breakout to record highs. They initiated yesterday. They longed the market above 71,000. And what that means is that today they need to get that market above 72,000. We get above 72,000, that's the May highs. That's going to bring more longs into it. That's going to bring more momentum into it. And that's what's going to get us back up towards that record territory price around 74,000. And like I said yesterday, no one wants to be short Bitcoin. Everyone just is waiting for a signal to be long. Okay, and that's the key takeaway. There are very few people that want to be short. Everyone just wants to join the momentum play. As soon as we get that signal, everyone's going to jump on, and it should be a relatively quick move above that 74,000 and beyond. Where it stops, who knows? Okay, it'll go as high as it wants to based on the momentum, based on the flow. There is no resistance. There are no levels. It's price discovery. Now, here's the caveat. Very much that break yesterday has got some longs in the market, and they're weak longs. They are not confident longs. If we do not break above 72,000 today, if we do not take out that May high today, those longs become vulnerable. There is a limited amount of time those longs have got to go inside, and it's pretty much today or tomorrow or perhaps early next week, but they don't have all the time in the world to get that price above 72,000. So it's a market in play, whether we go up to those record highs or whether we fail post the head fake and very quickly drop down all the way back towards the moving average that we've been hanging around for all year. So keep a close eye. It's a market in play, whether it's long or short. It's very much long, so long as we stay above that 71,000. We get back below there, we initiate shorts for a very aggressive down move as the profit taking ensues. One final note, Bitcoin should bid up today. Why? Well, because equities are taking flight. Nasdaq's back at record high. If Bitcoin cannot rally in an environment where everything is rallying, it's telling you a great deal about what comes next. Okay, guys, that's then a wrap for today. As always, good luck. Make sure you manage that risk. Go make some money.